Hello and welcome to India Tonight with me, Ankur Mishra and Shibani Gharat. And in this half 1 hour or so, we'll discuss all the news that matters to you. But we are going to start a very consumer-centric, a very people-centric kind of initiative which has been taken by Reserve Bank of India. Yes. Or not only that, there is also Reserve Bank of India has been tightening screws on stock brokers, particularly whereby a new norms has been released. First, Reserve Bank of India clamped down on bank lending to stock brokers from April 1, 2026. All credit to brokers and capital market intermediaries must be 100% secured by collateral, and no more unsecured or partial exposures are allowed. Banks are banned from funding brokers, proprietary trading and guarantee face stricter cash requirements. Brokerage stocks plunged as much as 10% today amid fears of reduced leverage and cooling derivatives volume. And Shibani, there were more initiatives which were taken by Reserve Bank of India, particularly on misselling.
Particularly on misselling, and very close to most of the consumers who are actually still visiting the physical banks. A crackdown on misselling draft rules under responsible business conduct. Effective mid-2026, ban forced bundling, misleading ads, dark patterns and incentives for pushing unsuitable products like insurance or mutual funds. Proven misselling means full refund plus compensation for customer losses. And third, harsher recovery rules hit banks hard. From July 2026, recovery agents face explicit bans on abusive language, threats, harassment of relatives, late night calls or public shaming, contacts limited to fixed hours, identity disclosure mandatory, and complaints must be resolved first. RBI's message is clear. Cleaner market, fairer practices, stronger borrower protection. Now, ET Now has relentlessly raised the issue of misselling, and ET Now's pursuit was also acknowledged by RBI Governor on February 6th. Let's listen into this interaction between ET Now's Anurag Shah and RBI Governor Sanjay Malhotra.
तो सर, जो मिस सेलिंग की गाइडलाइंस की आपने बात की है, तो उसमें माने कि ये इंश्योरेंस सेक्टर पर ही ज्यादा फोकस है, क्योंकि एफएसआर रिपोर्ट जो फाइनेंशियल स्टेबिलिटी रिपोर्ट रिजर्व बैंक के द्वारा जारी की गई थी, उसमें भी काफी चिंता जताई गई थी कि डिस्ट्रीब्यूशन कॉस्ट, कमीशन कॉस्ट जो है वो प्राइवेट लाइफ इंश्योरेंस कंपनियों के द्वारा जिस तरह से दी जा रही है, उससे इंश्योरेंस के पेनिट्रेशन पे और एफोर्डेबिलिटी पे काफी असर होगा। फिर हमने देखा सर, उसी का संज्ञान लेते हुए इकोनॉमिक सर्वे में भी उसको चिंता को जताया गया था, और हमने भी कई बार सर आपके सामने भी ये मुद्दा उठाया है। क्रेडिट लिंक प्रोडक्ट जो बेचे जाते हैं बैंकों के द्वारा, उससे लोगों को मिससेलिंग बढ़ती है। तो क्या सर इंश्योरेंस सेक्टर के लिए ये है, और सर आपने एक संज्ञान लिया इस दिक्कत का, उसके लिए भी सर ये स्वागत योग्य है।
सबसे पहले मैं ये कहना चाहूँगा कि मेरे ख्याल से अगर यदि आज हमारी पॉलिसी वक्तव्य से यदि कोई सबसे ज़्यादा खुश होगा तो वो अनुराग, जो दूसरे साइड पे बैठे हैं उनमें अनुराग होगा शायद, क्योंकि आप लोगों ने, मैंने कम से कम ये नोट किया, हर बार आपका ये प्रश्न जरूर आता था, हर बार आपने ये पूछा।
यस सर, तो वही सर
आप क्या कर रहे हैं,
संज्ञान लिया।
तो आप जो है सबसे अधिक इस बारे में खुश होंगे।
All right, so RBI Governor did acknowledge the efforts of ET Now's Anurag Shah, and persistently he had been asking questions about consumer misselling. To discuss about this issue on all the RBI regulations which has come recently, we have two eminent guests with us. We have Sriram Subramanian from InGovern, and we also have former chairman of State Bank of India, Mr. Dinesh Khara. First of all, I want to come to you, Mr. Khara. Now, even in the past guidelines, as far as I remember, there was a distinction between mis-selling and selling the product which suits the customer. Now, with the new guidelines which has been put into place, how much of the difference will be there? Is it more of a responsible conduct or the norms being in place?
Thank you very much, Anurag, first of all, for having me on your channel. Well, when it comes to mis-selling, I think this was something which is doing for quite some time. and it was engaging the attention of the government as well as the regulators, both at RBI as well as IRDA level. I would say that a couple of years back, there were some practices which were initiated by various responsible institutions, acknowledging the fact that banking is something which is a business of trust. So if at all it's a business of trust, that unless and until it's a right selling, there could be a challenge to its very basic brand. So that is one of the reasons why some of the banks on their own had also introduced some kind of a need assessment. When need assessment formats were introduced, and also they had started coming down quite heavily on the mis-selling. They had actually delinked the incentive structure from the sales targets, and if at all the sales targets were actually having a due focus on the bank's own products also. So I think this is something which was introduced a couple of years back, even 4 or 5 years back also this was introduced. And then on the top of it, banks had started looking at the persistency ratio, because the mis-selling also means that the persistency ratio should be low. So this is something which was being done. But these are all steps which are taken at a voluntary level, at a board level of the banks. But now, in this particular guideline which has been introduced by RBI, one, mis-selling has been defined very clearly. And secondly, they have also gone to the extent of saying that it might even have an impact on the license of the organization also, license of the bank also. So actually punitive measures which have been defined in this policy, they are very strict and harsher also. So I think this is something which is a very clear reflection of the intent of the regulator in terms of ensuring the implementation of the mis-selling guidelines. So I would actually put it in this context that, if at all you look at the premium which was mobilized by the insurance sector last year was somewhere to the tune of about 9 trillion, and out of which the credit life kind of an insurance premium was just about 30,000 odd crores. So if you really look at it, overall size, it does not really make much of difference. But nevertheless, the experience of the customer, if at all they are being cheated, this is going to have a significant impact on the trust factor, which might even jeopardize the trust of the customer in the banking structure also. So I think to that extent, it's a very welcome step, and it needs to be.
Absolutely. Thank you, Mr. Khara, for giving us insights into that. But now joining us is also Kembai Srinivas Rao, former GM Bank of Baroda and former Director, National Institute of Banking Studies and Corporate Management. He's also a professor, adjunct professor at the Institute of Insurance and Risk Management. Thank you again so much for joining us, Mr. Rao. Quickly over to you as a former banker. Help us understand, how do you, look at this move from simply having a board-approved policy to changing the ground level culture of cross-selling? Because I was just discussing with my colleague Ankur over here that I recently visited a public sector bank for something that, for a branch to a branch for something that I needed to change, and they were trying to move me away from one product to a ULIP product. And this has been something that has been going on for a very long time whenever I have actually visited a physical branch. So how does it change, the culture at the ground level when it comes to mis-selling?
See, a couple of things that RBI has brought very clearly this time, particularly in these guidelines, which will be effective from July 1st, is the dark patterns which are built in the documentation of the banks or in the conduct of banks cross-selling the non-core products. These are all non-core products, which we call. Core product is the banking products. Non-core are the fee-based products, which are third-party products, which are being coupled with core products. So that they have prohibited this time, that there should be no bond linking one product with another product, that is prohibited. And second thing that RBI has brought, no incentives to be attached to the non-core products to the individuals who sell these products. So that is another thing. The third thing is which they made it very clear that there should be no targeting as far as the sale sale of these products are concerned. Because for quite some time, I think Mr. Trivedi was very elaborately explaining, the RBI is very much concerned. Not only RBI, many of the stakeholders are very much concerned that this part of the non-core business is getting integrated with the core businesses of the bank and interfering with the core businesses also. And a lot of reputation of the banking system is at loss. So now what the question which you are asking, the remedy is, I think, the grassroots level training system of the employees and the percolation of these guidelines, board level policies, and making SOPs, standard operating procedures, and product pamphlets, and all these things are good. But what is more important is to send the strong message down to the line management, that is in the branches, that they should sell the non-core products without any pressure or with the option. And another thing which RBI has made very nicely, that even if a consent is given, if it is a unfit product for the customer, that is mis-selling is detected, then not only full refund will be given for that product, but also compensation will be given. So this time I think a lot of thought process has gone into in formulating these guidelines. I think they will enforce stricter discipline, not only at the corporate level, but at the middle level and also at the grassroots level. There is the branch level which you are talking about, as to moving away from the core businesses to the non-core businesses. So this time RBI has been very thoughtful in articulating certain conditions, that dark patterns like implied consent being given or bundling of the products, and then that this offer will go away in two days. That is, the time pressure is being given to the customers. So all those things are being taken away now. So dark patterns should not be there. There should not be any kind of apps which will be giving you the kind of
Mr. Rao, point taken. Of course, there is a lot of thought process which has been given by the regulator this time while framing the rules. I want to come to you, Mr. Subramanian, regarding the recent norms which has been released for stock brokers lending. Now there is a clear-cut no for proprietary trading. There is no for anything which is not secured for brokers. First of all, I want to understand that what is your understanding of the impact of the market sentiment per se, and also on stock brokers. We saw the market reaction today.
Yeah, good evening. So if you see, not just the RBI, but the FinMin level, finance minister and other regulators have been very cautious, or have been talking about the increased speculation in futures and options, and how the volumes have just shot up. There are a number of retail traders who are sort of trading, and that has been facilitated by increasing availability of credit to the traders. And as I read somewhere, 40% of trades, F&O trades, are done by proprietary desks. So from that perspective, cutting out complete credit facility to the proprietary desk is obviously going to impact how much margin the traders have to put up on their own, rather than avail of credit facilities from banks. Secondly, see, this is coming, the finance ministry has also tried to increase the STT on F&O trading, options trading. Previously there was some requirement, or at least there is a ask that only because retail traders are losing money, only authorized or people above net worth, only accredited investors be allowed to trade in F&O, etc. So, but what is happening now is that is percolating down to the RBI's regulations now. RBI that way, as you rightly said, proprietary trading, completely zero credit now from banks. Of course, people may try to find loopholes, but as they say, at least the banks who are in the right direction and want to do the right things and be compliant will have to necessarily adhere to these norms. And secondly, even other capital market intermediaries, the bank funding was going, and now for intraday trading also the collateral requirements is 100%. Previously it was only 50%. Now it's going to be 100%. So from that perspective, the margin requirement has doubled for proprietary traders on an intraday basis on the expiry day. That was a well-funded, well-known instrument, and that's the reason there is an impact on all the capital markets oriented stocks, the brokerage firms. BSE also has a listed exchange, so because whatever impact collectively, of course, if volumes come down in F&O will impact BSE's revenues. But this should likely cool down some speculative activity in F&O segments in the capital markets.
Absolutely. Over to you, Mr. Khara. I wanted to quickly check with you. Now the draft guidelines propose like a full refund and additional compensation to proven mis-selling. Now, do you believe this will also lead to, like, let's say, a surge of, frivolous claims by certain customers? Because there's a possibility of that happening. I can see a clear loophole over there. How do we fix this problem? How do we solve for this issue?
Actually, even in the current situation also, there's a free lookup period which has been permitted, which is about 30 days. And, all said and done, when it comes to insurance policies, it's never it's always a push product. It's never a pull product. So that is one of the reasons when you look at the penetration level also, it is just about 3.7% or so. So, at times there is a change of heart, which also happens. And but at the same time, if at all there is a need assessment which has been done, suppose if at all somebody is at the age of 71, he is being offered some kind of a protection policy, that does not make any sense. But yes, of course, if at all there could be genuine value creation also, if at all need assessment has been done properly. And what you have mentioned that in terms of the punitive measures which have been indicated, some kind of penalty, some kind of a the paying back of the total premium which has been charged. So all that is very much there. On the top of it now, RBI has gone to the extent of saying that it might even have an impact on the licensing of the authority of the institution also. While I'm saying all this, I must also mention that when it comes to bundling of product, very often it was seen that some of the NBFCs had such practices. I think they will have to now unbundle the product and they will have to again get into the need assessment, etc. So much larger broad-based institution will have to actually adopt the practices which are being done, which are being adopted by some of the leading institutions in the country. So I think as an intent, it's a very welcome step. But yes, of course, having said that, we have to probably ensure that if at all there is a change of heart, because invariably such kind of recordings are also there when people are being questioned about are they willing to take this product or not. So that can be probably played out to really verify the claims. The telephone calls are invariably recorded. That was already in place. That can also be played out. So I think, but yes, of course, there are multiple things which would be required to be understood before really getting into a final view. So that is what my sense is. But yes, of course, these are the draft guidelines, and they will probably, when the final guidelines comes, they will probably address these issues also, and it will be open for the viewpoint from all the stakeholders. I think the intent, there is no second thought. But yes, of course, when it comes to the way it should be implemented, maybe it would warrant some kind of tweaking as well, keeping in view of the ground level realities.
Right. Mr. Khara, I also want to get your reaction regarding two of the norms which has been released by Reserve Bank of India. One on M&A financing. Now 75% of the acquisition finance is now permitted as per the latest guidelines. And this is against 50% which was allowed and proposed in the draft guidelines. And also on the stockbrokers regulation, do you think there is going to be some kind of impact even on the bank funding?
Well, when it comes to, first of all, M&A financing, I think M&A financing has been introduced for the first time in India, which is actually a welcome step, and it is more in line with the changing economic scenario where now there are opportunities in the M&A space, and funding such opportunities through the Indian banks is a very welcome situation, because otherwise all these M&A opportunities were going past Indian banking system. They were all being funded by the foreign banks. So I think it's a very welcome situation. And I would say that as compared to the draft guidelines, the final instructions are actually much more relaxed also. In the draft guidelines, there was no provision for the unlisted entities to be acquired, but now it is also permissible. And also when it comes to these guidelines, they actually allow the leverage of the target entity to be refinanced as well. So I think these are very, very pragmatic steps which have been taken by RBI, and also when it comes to size, also it has become meaningful now. So I would say that this is a very welcome suggestion when it comes to the M&A financing by the Indian banking system. Your second question relating to impact of on the guidelines relating to the broker financing, etc. Yes, of course. I think what is intended to be curbed is something which is more like speculative trading, which was probably fueled in terms of when there was a funding at the proprietary level. That was something which is actually causing these concerns, and F&O was becoming one of the major focus areas. And also liberalized funding always lead to some such practices. I think RBI having come down in terms of reducing the LTVs and also increasing the cash collaterals actually will ensure that it will only lead to the right financing. And on the top of it, I must also mention, they have mentioned very clearly when it comes to market making kind of an activity, when it comes to working capital activity of the brokers, they will continue to be financed.
Absolutely.
So I think
Absolutely, Mr. Khara. Over to you, Mr. Rao. Now, another aspect of the consumer-facing, something that RBI has raised, an issue that RBI has raised, is RBI now holds banks directly liable for the conduct of the outsourced recovery agents. So no calls during late nights, no public shaming, no threatening, people on the calls or, face to face. So in your view, does this shift necessitate towards, let's say, insourcing of some of these functions? Because now we also have so much tech at our disposal when it comes to many of these private banks. So, is it going to be more technology-driven monitoring going forward? What is the change that we will see as an outcome of this diktat?
Madam, a couple of things that is going to happen, which is very positive, is first the due diligence of the agents, that is the recovery agents. There will be enhanced due diligence as far as the capacity of these agents to act in accordance with the conduct rules that are prescribed, and the monitoring system from the lender side will also be kept under control. And the second thing is they need to be certified by a training agency. Like IIBF is being recognized as one of those training agencies which will be giving training. So they need to be certified. It means those who will be engaged as your recovery agents will also be. And one more thing which RBI has made it clear, that one should not hurriedly go for legal action or sending the recovery agents to the borrowers, but a soft method of recovery has to be first attempted, exhausted, and then only should move to this resort of sending the recovery agents. To my mind, I think it will bring a very good transformation as far as the conduct of the agents are concerned, recovery agents. And banks also will be more particular in engaging them. And also, one more thing which needs to be fixed by the banks is the compensation, which is linked to the amount of recovery and the pace at which the recovery is being enforced. I think these linkages will have to be sorted out, and so that the recovery agents will not be using so much of force or what you call not so good conduct as far as the recovery methods are concerned. They should not use them, abusive systems, just to enforce recovery. So I think these recovery guidelines which have been now rolled out and which will be enforced from 1st of July, I think they are done after a lot of thought process. It should bring a lot of transformation as far as the conduct of the recovery agents and also the attitude of the banks in enforcing the recoveries. And now that the large number of small loans have increased in the banking system after we have gone for retail lending in a massive way, so recovery agents have to be utilized for that purpose. But I think a lot of change will come, and I think we will see in the next 6 months from July onwards that there will be some kind of good behavior of the recovery agents, and also banks will have standard operating procedures. Of course, they have as of now also, but they will have more stricter standard operating procedures in contacting the defaulters, and also while engaging the task to the recovery agents. I think a lot of improvement will be there from both sides. And as far as the technology is concerned, now I think all alerts, they move through the
Right, Mr. Rao, point well taken. Now, this is a system where all the entities, stakeholders needs to adapt to a new reality. And hence, I want to come to you for a quick reaction, Mr. Subramanian. Now, these norms are in place. We are also hearing that, of course, there is a reach out to regulator for some of the concessions. But B, I want to understand, is it going to be now survival of fittest for the brokers and they have to adapt to new system?
Yes and no. I don't think this is the only fuel or this is the only funding source for all brokers. Brokers obviously rely on trust of their customers. The volumes may go down. I don't think there is any need to panic for the brokers as far as I would think survival of the fittest when you say the brokers going out of business in that sense. I don't think any broker will go out of business. If anything, they can reduce the volumes. They can customers may move shop a bit, but I don't think any broker is going to shut shop.
Mr. Subramanian, thank you so much, Mr. Subramanian, Mr. Khara and Mr. Rao for joining us and sharing and giving away your inputs on the RBI crackdown. Thanks again for joining us on ET Now.
Thank you very much. Thank you.
Bye-bye.
Well, on that note, it is time for us to slip into a very short break on India Tonight. You don't go anywhere. Lots of news and all the action from the AI Summit on the other side of this break.